First of all, we wish you and your loved ones good health and hope all are vaccinated or in the process. Do take care and stay safe. Billionaire investors, if we think of them, it's a mixture of wow and hard work. Clearly, they think differently, they do things differently. But are the skills they possess transferable? Can we really be like them? We are sure they all have something to teach us besides how did they build wealth. Motilal Oswal Wealth Management brings to you yet another insightful Vantage Point series. With this series, our endeavor is to bring to you powerful insights from promoters, entrepreneurs, authors, and many other eminent personalities. This time we have an ultra-special guest. Award-winning journalist Mr. William Green with his bestseller book Richer, Wiser, Happier. The book is the culmination of his 25 years of experience interviewing investment wizards and billionaires, discovering their talent well beyond the investment realm and into practical philosophy. He brings gems of insights from known legends like Mr. Warren Buffett, Sir John Templeton, to hidden legends like Jean-Marie Aveyard, Mr. Monish Pabrai, etc. This session was moderated by Mr. Ashish Shankar. The session was divided into two major parts. In the first part, Mr. Green ushers us into the thinking of three different legends that will enrich you not only financially, but also professionally and personally. Then we move on to a few very interesting questions asked. Born and raised in London, Mr. Green studied at Oxford University and received a master's from Columbia University. As an editor and co-author, he has collaborated on several bestsellers books and also earned many prestigious awards. So, let's begin the rendezvous with rich insights from legends. Introducing the first legend and the men who cloned Mr. Warren Buffett. Mr. Pabrai discovered the stock market after high school. In 1990, he launched a technology company named Transtech. The driver for him was not getting wealthy, but winning the game. With this drive, his flagship hedge fund was 1,204% versus 159 for the S&P Fund Index. He became one of the leading investors simply by cloning the master. So let us see the cloning lessons from Mr. Pabrai. According to Mr. Pabrai, humans have a problem that prohibits them to adopt good ideas, as to replicate someone's idea is being guilty and not being creative. But him, being the most relentless cloner, has taken the art of appropriation to the extent that the idea seems original. So, he had 3 steps to picking stocks learned from the minds of Buffett, Munger and others. Step 1 is whenever you buy a stock, you are purchasing a portion of an ongoing business with an underlying value, not just a name in the portfolio for speculators to trade. So the essence of the game is to detaching yourself from the madness and watch it dispassionately, as you don't have to hit every ball out of the stadium. Step 2. Graham viewed the market as a voting machine, not a weighing machine, which means stock prices are either overly pessimistic or optimistic, failing to reflect the true value of the business. So the number 1 skill in investing is extreme patience. Step 3. One should buy a stock only when it's selling for much less than your conservative estimate of its worth. The gap between a company's intrinsic value and its stock price provides what Graham called a margin of safety. In financial markets, almost anything can happen, and it pays to conduct your affairs, so no matter how lame other people get, you should be around to play the game the next day. To conclude, Mr. Pabrai's principles were easy yet complicated. So, Rule 1 is clone like crazy. Rule 2, hang out with people who are better than you. Rule 3, treat life as a game, not a survival contest. Rule 4 is to be in alignment with who you are. Don't do what you don't want to do, or what's not right for you. Rule 5. Live by your own scorecard. Don't be defined and governed by external validation. There is a very fine line that separates genius from the crazies. You have to have a strong belief system, even when your family, friends, colleagues are not with you. This tiny percentage of people have their own world, and the willingness to be lonely. And that's the second legend we are talking about, Sir John Templeton. Sir John Templeton, one of the greatest investors of the 20th century. an early innovator in both international and contrarian investing. Known for his crazy bet during World War when Germany invaded Poland. When everyone's approach was to retreat from the market, he invested $100 in 104 different companies. After 4 years of holding the stock despite the negativity, to everyone's surprise, his portfolio grew 5 times. Even in the darkest of times, he never forgot that the sun also rises. So what do we learn from him? The 6 wisdom principles he shared are the fruit of more than 60 years of practical experience. First of all, beware of the emotion. Most of us get swayed away by the emotions of greed and fear. To buy when others are selling and to sell when others are buying is the most difficult thing. Secondly, beware of ignorance, probably because many people buy something they don't understand. So as an investor, ask yourself, do I have more experience, time, and wisdom than the professionals? Third, one should diversify broadly to protect from your own mistakes. Don't put all your money with one fund manager or one asset class. He recommends every investor should own a minimum of 5 mutual funds focused on different areas of the financial markets. Fourth, successful investing requires an ample amount of patience. People who change from one fund to another often are basing it more on emotions than research. Fifth, the best way to bargain is to study which assets have performed most dismally in the past 5 years, then assess whether the cause of those woes is temporary or permanent. Most people are drawn to successful investments, popular with the market. But as they are overly popular, they are heavily priced. Templeton suggests an opposite approach and says, where is the outlook worst, and constantly asking which one is the lowest priced compared to its actual worth. Sixth, have a resilient wealth creation process and be obsessed with keeping a calm temperament and stay in the game. Sir Templeton did everything in his power to maintain his mental and emotional equilibrium during the dot-com bubble or during the World War. So, don't focus on the outcome. Focus on yourself. To conclude, Sir Templeton didn't just master the markets, he mastered himself. He took responsibility for every aspect of his life, and this required extraordinary self-discipline and temperament. Yet another story of an investor who almost had a near-death experience. Presenting the third legend of the story, Jean-Marie Veyard, the resilient investor. One of the finest investors who obediently followed the mediocre path for 15 years, and even after that had 3 bad years, where his flagship fund performed miserably. He lost 70% of his clients by the 3rd year. During the tech bubble in the late 90s, many companies got public, got 600% in a day. However, Jean stayed resilient, super rational, didn't invest in the ride, and took an extreme position of owning no tech at all. Everyone went against him. His wife, his team, his board members. Eventually, he started doubting himself. Post 2 months of funds sold, on March 10th, the bubble burst and he emerged as the winner. He was honored with a number of awards. But what made him a resilient investor? The first step is to respect the fact that there will be uncertainty. We cannot predict timing, events, triggers, but we need to expect them and be prepared so that we can soften the impact. How? By identifying and consciously removing our vulnerabilities. Secondly, to achieve resilience, reduce debt, leverage, and beware of excessive expenses. This makes us dependent on others and thereby increasing our vulnerability to external events. The third step is to not focus on short-term gain or beating the benchmark, but the emphasis should be on becoming shock-resistant and staying in the game. Fourth, don't be overconfident and have a habit of trusting that the future will resemble the recent past. Lastly, we should be keenly aware of our exposure to risk and require a margin of safety. The list of investors will not be complete if we don't mention the legendary Charlie Munger. Buffett once declared that Charlie can analyze and evaluate any kind of deal faster and more accurately than any man alive. He sees any valid weaknesses in merely 60 seconds and sees the essence of everything before you can even finish the sentence. Mr. Munger adopts one practice that all of us should clone, that is, he strives to consistently reduce his capacity for lame decisions, standard stupidities, by not being smart but by focusing on the problem backward. If one just identifies all the disasters and says what could cause that and try to avoid them, it's a very simple way. Secondly, he mentions not to pay too much, to avoid going for businesses that are prone to obsolescence and destruction. It was not the scale of their victory, but it was the manner in which they have won. Example of how they did not invest in the tobacco snuff company, knowing that though it was a great product, it was killing people, and hence decided not to invest. It was this quality of trying to win in an ethical way that was part of the secret. Third, always discuss your mistakes with others. The more transparent you are about the mistakes, the less likely you are to repeat them. When Mr. Munger and Mr. Buffet attended the Berkshire Hathaway annual meeting in 2017, they admitted the mistake of not buying Google and Walmart. Fourth, we often tend to prioritize information that reinforces our belief system and values and do not think rationally. This mistake of clinging blindly to our existing convictions can lead us to overconfidence and thereby a mistake. That helps understand why so many investors get into a belief that they can outpace the market in the longer run, despite lacking the temperament, skills, and control over the cost. Lastly, adopting systematic analytical procedures eliminates our cognitive irrational limitations and helps us think methodically. These disciplined techniques help us systematically to slow down, open our minds, and consider risks that we might otherwise overlook. To conclude the 5 techniques to avoid lame decisions as mentioned by Mr. Munger. First, focus on the problem backwards. Second, avoid businesses that are destructing humans. Be ethical. Third, be transparent about your mistakes. Fourth, keep an open mind and challenge your beliefs, values. Lastly, have a systematic process that will keep you objective and rational. Wow, wasn't that an amazing piece of information? Moving on to the last segment of the webinar, the question and answer round. On being asked, how patient would you be with a manager who is underperforming and for how long? He mentioned that he maintains an Excel sheet of his investments and updates it every few weeks. Then he has a set under each category and that cannot be sold for 5 years. Secondly, he believes in taking fewer decisions, as it gives better clarity. Third, he looks for honest managers who have simple processes, the same interest, and have skin in the game. Fund underperforming but managed by a good fund manager can be a good strategy. On being asked, what are some key mistakes fund managers have made, and he explored during the interviews, he mentioned,
I spent a lot of time with Bill Miller over the years. I've interviewed him somewhere between 80 and 100 hours over the last 20 years, starting with a profile that I wrote of him for Fortune many years ago, 20-something years ago. And he's one of the cleverest investors you'll ever meet. Absolutely extraordinary mind, thrilling mind. And he famously beat the market for 15 years running when he was running the Legg Mason Value Trust, which is it's an impossible feat. It's defying gravity, basically. And then during the financial crisis, the global financial crisis during 2008, 2009, he made this catastrophic mistake where he basically decided that all of these companies that were melting down, they would be rescued when the Fed came in and propped them up. And in some ways, it was very similar to the bet that Templeton had made during World War II, where in some ways it was survival of the unfittest, that the companies that had done worst would bounce back really sharply because they'd gone through this kind of near-death experience, and then suddenly they would revive. And so all of these companies like Merrill Lynch and Countrywide Financial, that were Bear Stearns, that were melting down, Miller kept loading up on more of these companies as they were melting down. And for once in his career, instead of this contrarian approach turning out to be brilliant, it turned out to be catastrophic. And he lost something like 65% in his smaller fund and about 55% in his larger fund. And as had happened with Jean-Marie Eveillard, all of the investors flooded out. And so he went from having $77 billion under management, having 800 million under management. And that was a really fascinating mistake to discuss with Miller. And one of the things, and Miller's remarkable and very honest, and I'm a huge admirer of his, and he's bounced back to an extraordinary degree. And and actually, I mean, we can talk about this more, but I think has totally redeemed himself and vindicated himself as one of the greatest investors of our generation. But when I talked to him about the lessons of his mistake during the financial crisis, it was to some degree overconfidence. He said that at a certain point, when you've been right for so many years, you start to believe that you're omnipotent. So even though theoretically you know that we're all vulnerable to mistakes and overconfidence, he said he started to believe in his own hype. And so he took a little too much risk and he became too concentrated and too confident. And so he said one of the simple lessons that he's learned is actually just to diversify a little more. So now he probably owns about 45 stocks, that sort of thing, because he said, I wasn't really aware of that I could be so catastrophically wrong. I was aware that I could be wrong, but not so catastrophically wrong. And so I think that simple lesson, that if someone as brilliant as Miller can be wrong, all of us are very vulnerable to overconfidence and to analytical mistakes. And so this idea of having to hedge against your own fallibility is really a profound.
So what does one learn from this mistake? First, because you have been right for a very long time, you become overconfident, and that is where you make the mistake. Secondly, one should know that despite the success, everyone is vulnerable to mistakes, and so is the ability to bounce back from a setback, and that is the greatest lesson from Miller's mistake. So what are investors thought beyond getting rich? Irving Kahn mentioned that life isn't just about money, but it's about family, having grandchildren, building something out of the company. He also mentioned everyone at some point of time is confused, directionless. You need someone alongside to ask for directions. Building capital is important, because you can be independent and do whatever you want to. Another hidden legend, Jason Karp mentions that whether in investing or in life, there's so much randomness that can drive one insane. If you get things right, it feels great, but you get it wrong often and you have to keep coming back. So resilience, reinvention, or maybe cloning something new is a prerequisite for happiness in life. Wasn't that amazing information about how to live rich, wiser, and happier? As always, we thank you for attending the webinars and watching the video. We thank Mr. William Green for his time and efforts in bringing such profound interviews to us. We will continue to host such insightful webinars with stellar speakers in future.